Jimmy, how are you doing today?
I'm great, Jeremy. How are you?
Great. Ready to do another Between Two Fiduciaries. This week we've got the title Am I Average? It's kind of a funny
I
title.
love it.
You guys will see what it's
Yeah.
all about here in just a moment. So, what we're showing here is a study that's been around since 1994 by a research company called Dalbar. And they do what's called the quantitative analysis of investor behavior. So, it really provides this long term track record of how average different types of investors are performing.
Yeah, and I think the easiest way to explain the way that they have identified who is average and who's a professional is by looking at the trades that are made and the lot sizes of those trades. It's pretty easy to see when, Joe from down the street is buying Apple stock versus when Warren Buffett is buying Apple stock.
Right.
Come in much different increments. So, as a quick and easy way to understand how have they identified this, that's a very shortened version of how they've identified who's average and who's a professional.
Got it. Yeah. So what we're seeing here is that we look at a 30-year trend, and then it breaks it down into smaller bits and chunks: 20, 10, 5, and 3.
Yep.
The first one here is the average equity investor. We know that taking a little bit more risk in the equity markets usually pays off in the long run.
Right, exactly. So these are investing in mutual funds that are using managers that are picking stocks, and what you'll see is the returns are relative to some of the other columns here not so bad.
Right. And then you've got the average fixed income fund investor. Now, surprisingly, this one has performed really poorly over the last 30 years. Now, we think part of that is it's swayed by the last 10 years having been a particularly bad time for fixed income.
Yeah, I mean, that's as the Federal Reserve basically cut rates to zero in light of the 2008 crisis we were going through. That we sort of stayed at that flat line for the next decade plus, and so there hasn't been a whole lot of yield to be had, and that has driven a lot of equity intense investing, and then you add in the fact of these are this is the average number, and a lot of these people are picking funds that are not doing as well as the benchmark is.
Great point. The next one, sort of in the center here, is the average asset allocation fund investor. So this is somebody who's got a mix of stocks and bonds in their portfolio.
Right, and we talk about asset allocation a lot, and it's the importance of it is it drives so much of your return, right? And it's really important that everybody understands the risk that they have under the hood of how are they actually invested from an equity to fixed income perspective. And you should have some sort of blend. You should expect to see some sort of blend between the stock and bonds when you look at the average asset allocation investor.
Now, the average asset allocation fund investor has probably been really particularly hurt by this past year. But it's all relative, and we'll get into that in a moment. But you would see that the average asset allocation fund investor isn't doing particularly well. They're not even keeping up with inflation. So what does that tell you about risk and reward?
Yeah, well, I think that's a great point. It's the risk that you're taking, that they're not getting enough juice for the squeeze that they're taking, right? And understanding where to take those risks and making some sort of tactical shifts in the allocation when the time is right is not being that's not an activity being undertaken by the average asset allocation investor.
Last one I want to touch on here really is the S&P 500.
Yeah.
We just know that this is a great performer, right? It's been consistently a great performer, 50-plus year track record of 10% annualized returns, and it's showing it here.
Yeah, so the S&P 500 is made up of, as you believe, 500 of the largest companies, and it's a market weighted index, and it's we've seen incredible growth, particularly in the last decade plus, with your Facebooks and your Amazons and your Netflix and your Googles, and Apple has been one of the best holdings and driven a lot of performance here, but it's the average equity investor is underperforming that S&P 500 by a good amount.
Last thing we'll say on this slide is that we were talking about this earlier. A lot of people think that they're better than average. They think you were talking about it in terms of I'm a better than average driver.
Yeah.
Right? You ask a room full of people, and what happens?
That's exactly right. That was how this study was presented to me. Was ask a group of people who believes that they're a better than above average driver, and the response that they got was over 90% of the responses were that they thought they were better than average, which by law is not true. So you got a lot of people out there that are below average investors that don't believe they're actually below average investors.
That's right. And so the facts are the facts, and that's what we're just trying to put it out there for everybody to see what this looks like. This is the same study, Dalbar study, looking at 2022. These numbers were just published. Obviously, it takes a little bit of time to crunch the numbers.
Right.
So we want to highlight two different things for people. How did the average equity fund investor perform in 2022?
Mm-hmm.
And how did that compare to the average asset allocation fund investor?
Yeah, I think so 2022 obviously was not a good year for markets. The only positive bar we see here is inflation. Inflation is up and markets across the board were down. So it clearly was not a good year for any investor in 2022. But particularly the average equity fund investor was getting beat up. And there's a lot of things that play out there. The emotional bias of getting in and out of the market when they think that they can't afford to lose. They don't have a plan to guide them. They're making irrational and emotional decisions. Oftentimes, the mutual funds that they're investing in can come with heavy expense ratios that they're unaware of. There might be commission funds that they're buying in there that are eating away at their return. So again, harming them or holding them back from just even performing, on par with the benchmark. So, but you certainly saw the benefit in 2022 of not having all of your eggs in just the equity basket, and that's where you see, the second box there, that the average asset allocation investor did outperform the average equity fund investor for the full year.
I think it's a good point. The study itself does a good point of saying, hey, look, if there was a rock star this year as the asset allocation investor.
Right, exactly.
Nobody likes to lose 15%, but you know what you hate even more is losing 21, 22%.
And you feel like this number would look even better if we didn't have such a anomaly from a poor performance from the fixed income side.
Yeah.
I mean, it was less bad than the equity side, but typically we would expect it to hold up better than it did.
Correct.
So I feel like, yes, the average asset allocation investor was the winner. In more situations like this, I would expect the win to be even a larger gap in similar environments.
No doubt about it. So a lot going on here. We talk about asset allocation a lot. We wanted to look at this one from Y charts here. What we highlight is the quarterly performance in 2022. So it's keeping the continuity from that last slide that you saw to, hey, what was performing and what was underperforming in 2022?
Right, exactly. So you see the commodities up at the top in the first and second quarter as the top returning asset classes for the first half of 2022, which I think, again, you'd expect, given a year where inflation was running rampant, you would expect the commodity prices would be rising and that the commodity funds would be doing well.
Exactly. Now, what we saw on the other trend that we started to kind of see in here was they call it World X USA, which is really international developed funds.
Yep.
That's starting to take a foothold. That certainly has been something that we think is a new trend cycle that we're entering into. But it's interesting looking at this to see how the world was sort of flipped upside down a little bit from what had known previously.
For sure.
Now, here's another look at it quarter by quarter. What we kind of want people to do when they're looking at this slide is just take a look at each of the performers in the different color categories. So for instance, in that red color at the top, that's U.S. growth. That's large cap growth based equities. And they've been a real consistent performer over the last 10 years. They're near or at the top almost every cycle.
Right. The hard part about this is that they've been at the top for the last decade when interest rates have been held at zero.
Exactly. Right. So it's not necessarily, the past here is not going to necessarily dictate the future.
That's exactly right.
We talked about it before, the new cycle with international. You can start to see it's rearing its positive head in the last call it 6 months.
Yeah, I think we noted in a previous version of this that when we point out when the U.S. dollar broke down below its 200-day moving average in the fourth quarter of 2022, that was a signal that we started to track and follow, and it has played itself out nicely since then. That yes, the world stocks ex the United States have performed very well since then.
Absolutely. So then the next one in the green, S&P 500, again, that is sort of similar to the U.S. growth, right? There's a correlation there. They've been performing very well. The new cycle here, emerging markets, that's also an international flair to it, right? It's just less developed countries. And so they've been outperforming. And then the back in black, this is interesting. So U.S. Treasuries and aggregate bonds. Now all of a sudden we're starting to see them take a more prominent space within the grid.
Right. So again, as we alluded to, the U.S. growth has done so well in a zero interest rate environment. And now we're actually seeing fixed income have a real meaningful place in the portfolio to an extent that we haven't seen in the past decade. So back in black, I think it's a very fitting title.
Slow and steady, the muni bonds. High income earners, this is a place where they go so that they can not pay not pay federal income taxes,
right.
Sometimes not pay state income taxes. This has just been consistent performer. And so that's kind of what you want it to do.
Yeah, I was going to say, I mean, fixed income is not supposed to be, super fun and exciting. And I think a lot of people really enjoy and appreciate having a ballast to the portfolio.
No doubt about it. And then contrary to that, you've got the roller coaster ride of small cap and U.S. real estate REITs.
Right. I mean, I think if you extended this, the periodic table of returns here even further, you see that the REITs, it's very consistently top or bottom. It's usually not very much in between.
That's for sure.
So they're either the top performer or they're down below near the bottom of the chart here. So they're very attractive and appealing when the time is right, but it's always important to how do you determine when the time is right?
That's right. And the same story could be said of the commodities, as we mentioned
for
before.
Sure.
Lastly, in that kind of light blue teal is the fundamentals, U.S. value, right? So hasn't necessarily outperformed in a massive fashion. However, we still think there's a lot of opportunity there.
Yeah, again, coming up the last decade where you've had this zero interest rate environment, the growth stocks have propelled forward and the value stocks have been held back. If you believe that we are going to the Federal Reserve is going to hike and hold, it wouldn't be too surprising to see value stocks come back in a meaningful way and outperform the growth counterparts.
So look, if you're average, that's okay, right?
It's great.
But you want to obviously be better than average, right?
Yeah.
There are ways to do that. There's a million ways to be less than average, though, right? And that's one of the risks that investors face.
Yeah. Well, again, we've talked about it before. We harp on this all the time. If you don't have a financial plan to guide you, to help guide your asset allocation and your investment philosophy, it's really easy to make poor decisions that are rooted in emotions that just as study after study has proven, lead you down the wrong path more times than not.
Well, thanks for sticking around with us today and looking at that Dow Bar research. We really appreciate your time today.
Absolutely.